Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
What's up, everybody? Anthony Crudele here, and thank you for tuning in to our Best Moments episode for February. Futures Radio Show is sponsored by CME Group. They are the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com. Remember, new shows are posted on Mondays and Thursdays. You can subscribe to the show on iTunes, YouTube, Google Podcasts, Spotify, and Stitcher. If you're enjoying the show, everybody, please leave a review on iTunes. This show is also sponsored by Trading Technologies, FTSE Russell, and RJO Futures. To learn about some great offers that these sponsors have for our listeners, please visit futuresradioshow.com/sponsors. Wow, what a busy month for the markets. February was probably the busiest month I've seen since 2008, and I think that March has the potential to be just as busy. February was also a very busy month on the podcast. I began the month by chatting with Mark Yusko. Then we had on Danielle DiMartino Booth, Anthony Drager, Kevin Davey, Tracy Schuchart, otherwise known as Shy Girl, and ended the month with Raggy Horner. I went through each episode and pulled my favorite moments and compiled them into one episode. So without further ado, let me take you to the best moments of February. What I want to do with you right now is I want to talk about what your mindset was at the end of the year and some of the things that you were looking to invest in, or things that you were investing in and trading coming into 2020. And as you and I are recording today, we just got the closing bell from the first month of January. So I kind of want to see if anything has changed at all with you. So take us back to what you were thinking at the end of the year and what you were looking to invest in and trade in heading into 2020.
This business is so humbling, right? You can work so hard and think you have an edge and think you've got the inside scoop and then things turn out exactly the opposite of the way you thought. And 2019 was one of those years, and I've taken a lot of grief on Twitter and in the media for, I was very bearish about equity markets, U.S. equity markets, starting in October of 2018, and looked pretty prescient in fourth quarter of 18. I said the market could fall as much as 40% to get to fair value, and it was down 18% through December 24th, 18, and then they summoned up the plunge protection team, and I just really didn't believe they had the gas in the tank. I actually labeled it the covered as bear market. I just didn't think that there was any more gas left in the QE tank. I didn't think there was anybody left to buy. Buybacks were starting to dry up. And obviously I was just dead wrong, right? I mean, just absolutely dead wrong. And U.S. equity market up 31.5%. And I was talking to somebody who was trying to, pretty much poke fun and make an example of me. And they said, you must have had a terrible year. And I said, well, see, that's the problem is you assume because I was negative on one asset, which was the index of the S&P 500, that I suddenly sold everything and went short that one thing. And I said, well, what I actually did a year ago is I did get out of U.S. stocks by and large. But I built a portfolio and it had 6 things in it. And so all during 2019, I pretty much owned 6 things. I owned our hedged equity strategy, which is, long short. I owned our emerging markets long only strategy because I thought emerging markets were cheaper than the U.S. I owned Bitcoin, and we'll talk probably some about that later. And then I owned a proxy for Bitcoin mining, AMD. And then I owned long bonds as a deflation hedge through an ETF called TLT. And then I owned some cash, right? So I was a little bit of hedge. And so when you put those 6 things together, so cash was basically flat. My long bond portfolio or ETF was up about 18%, which is not bad. Bonds up 18%, it's pretty good. AMD was up about 140% because it was just a rocket ship. And I did sell too early, right? I sold in the mid 30s and it's at 47 today. So I sold too early. Had a bad day 2 days ago, but I'm happy to. I'm always, the Brad Baruch had a great line about that. He said, "I made all my money from selling too soon." I love that line. Our Bitcoin obviously was up 92%, GBTC. And then our emerging markets fund was up 38%, which is pretty good. And our long short fund was up, low double digits. So, not very good relative to stocks, but pretty good relative to hedge funds. So my whole portfolio was up about, a little less than 50%, which is better than 31. And so I was taking a lot of grief about being bearish. This what I still consider to be a very overvalued asset, the S&P 500. Yet again, people get so myopically focused on one thing you said or one thing. And, it's so funny because in this business, what I found is the people who are so afraid of being wrong don't make any money because they never engage. And they stay too conservatively invested and they don't take risk. And those of us like myself, I'm wrong all the time. In fact, I strive to be right, 51, 52% of the time. The legends in the business are right 58% of the time. Average person's right about 35, 40%. So I'm striving to be right 51. But I don't care if I'm wrong. It's like Soros said, one of my favorite lines, it's not whether you're right or wrong. It's how much money you make when you're right and how much you lose when you're wrong.
Absolutely.
So anyway, to answer your question, coming into this year, I was, kind of licking my wounds a little bit because, your ego gets bruised to people saying you're an idiot online. But, good thing in Twitter is you can block those people. But the key is that I was kind of an idiot. I mean, I missed that don't fight the Fed. I missed the plunge protection team and Mnuchin calling up the banks and say, hey, you got to buy stocks. Okay, I missed that. But I actually didn't miss the opportunity to make money because I had other things that I loved and other things that I was doing all right. So I kind of got over licking my wounds and got over the ego bruise and came into this year really focused on, look, I think this is a time to play defense, not offense. It's Super Bowl weekend, and we know one thing. The team that plays better defense on Sunday will win the game. Defense wins championships. It always has. And I think that's going to be really important. And look, I didn't know the coronavirus was going to happen. I had no idea. And I actually don't think it's going to, I'm touching wood right now. I actually don't think it's going to be as bad as people are trying to make it out to be. You go back to swine flu 10 years ago, swine flu killed 18,000 people and no one talks about it. Coronavirus has, there's been a number of deaths, a couple hundred deaths, but we're in no way close to what swine flu did or what even SARS did. And yet the reaction this time has been so extreme that I think that's going to have a huge ripple effect in terms of growth and trade. And I think there'll be a lot of negative surprises in those areas going forward.
All right, I want to do a little rapid fire before we get into the rapid fire. And what I want to do is I just want to give you some markets, and I just want you to basically tell me what you think the macro theme is for those markets. If you're bullish, a little bit reasons why, bearish reasons why, neutral, some reasons why. So let's start off with just the stock market.
Well, let's see, the stock market. I'm bullish as long as the Fed moves from buying treasury bills into buying coupons and continues to increase the size of its balance sheet. As long as the liquidity is flowing, there's no reason to think that the stock market rally should come to a halt.
Crude oil.
I would have to say that that's a big depends. Right now, I'm neutral with downside risk simply because we don't know how many bankruptcies are going to be coming out of this sector, and we have no idea what global demand is going to do or not do in the coming months. I'd be very careful about playing this sector, but I'd add to that valuations are certainly getting really, really cheap. If you know the business and if you understand the shale patch, there might be buying opportunities if you want to get in early here.
Gold.
I think as long as the printing presses worldwide are humming and going, I think that you've got upside in gold prices. I think the precious metals area in general has got great upside from here. And I think that that's one of the best ways that you can hedge your portfolio.
10-year.
Gosh, I don't want to seem like I'm wishy-washy here, but I'm not. I have no crystal ball on this. I think if the coronavirus goes away in 1 or 2 quarters, that we could see serious upside in the 10-year with the warning that 2% is the new 3%. So I think that 2% barrier is what really scares traders away, whereas a year ago it might have been 3% that was the upper threshold. If the situation in China gets worse, I think we could see the 10-year yield trade down to 1%.
30-year bonds.
30-year bonds, it was interesting to see that they were flirting with 2% a few days ago. I think that the 30-year might be a little bit rich here.
How about any currencies that you are following? Are you watching the euro, the pound? Talk to us about any of those.
Well, I think it was telling especially with the pound, that we saw the UK's PMI pop up to 50. Look, they've got their own currency. The Brexit situation, I don't think, is going to be as dire as what a lot of traders and strategists had been concerned about. So I think that you're going to certainly see stability in the pound. And as far as the euro, I would again walk very cautiously. We saw Italy and France both go into contraction in the fourth quarter. Those GDP red prints were not expected. And again, if it's only Germany that's holding up the continent, we could be in for some bumpy rides, and the euro could see some downside from here.
Last week, I had our friend Mark Yusko on the show, and of course, we talked about Bitcoin, and he said he's doubling up on Bitcoin this year. What are your thoughts on Bitcoin?
Well, look, I think that Bitcoin is the most. I think Bitcoin is your modern day gold. It reflects an anxiety that is rightfully out there that central banks are printing away the underlying value of their country's currencies. So there's a certain rationale that I'd like about Bitcoin. I think it's too expensive, however, to manufacture. So I think when quantum enters the picture, then you could possibly have real upside in the crypto space. I'm just not quite there yet because, again, we have seen some serious issues when it comes to security of coin, and those are going to have to be corrected before you can actually say, I've got my full confidence in this, because you have to have sanctity if you're talking about having a currency substitute.
Do you own any Bitcoin?
I do not, but I own gold.
U.S. dollar.
I think the U.S. dollar continues to benefit, even though everybody wants to get against it. But as long as the United States remains the most attractive horse in the glue factory, I think that it will continue to be the beneficiary of safe haven flows. Last year, Quill Intelligence called for the dollar to end the year higher. It did. And I don't see any reason that there should be major downside in the dollar this year. I'm going to throw the caveat out there with the condition that crude oil prices don't drag the U.S. economy into recession. That's how important crude is.
Any markets that I missed that you want to talk about?
I think that the high yield bond market and is as well as the triple B market maintain this kind of they're problematic. They're the current cycle's problem children. And we've seen a doubling in the size of the corporate bond market. We've never seen non-financial business debt in this country anywhere near where it is. It's a record 74% of U.S. GDP. So I would be very cautious about owning any of these markets blindly through ETFs and understand individual credits and own bonds that way rather than try and play markets in a wholesale fashion, because you do see that the prices of some of these exchange traded funds and indexes gap down quickly. So if you're going to own them, own individual securities.
Hey everybody, a quick pause here to talk about FTSE Russell. They are a leading global provider of benchmarks, analytics, and data solutions. The Russell 2000 Index is a key benchmark for small cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 Index Futures Contract, symbol RTY. For more information on FTSE Russell and their products, please visit FTSERussell.com. We've already talked about how you've gone from short-term day trading to a swing trader. I too have gone from really short-term scalping to just trading intraday. Not necessarily a swing trader, but kind of a combo of a swing/day trader where I primarily hold my positions throughout the day now. I'm not in and out like I used to be, but even that transition from me was difficult because trading both sides so often, or trading all the different levels that I have that might be hit in a day, going from that to holding a position for the day, one of the most difficult things for me to do was stay away from an intraday opportunity that I thought I could make money on. Because, as traders, I think we always think we see edges. Therefore, when you're sitting in a position, holding a position, and you're used to a style where you would be taking these trades in the past and now you're not, that was tough for me. How have you been able to adjust your mindset to go from being someone who was a short-term day trader to a swing trader?
I mean, I still do that. I mean, I still look at them, I'm sitting in front of my screen all day and I'm still looking at intraday going, ooh, that would have been, I still comment to myself in my head, right? I'm like, oh, that would, that would have been a good long there or whatever. But really I found, and you have to find really what works for you. Like I have found so much more peace, not intraday trading and not day trading. And it really, actually, I feel like in a way, I should have been doing this a lot longer. But I was so stubborn and stuck in that, day trade mode. Had I switched, it suits my personality better. I just didn't realize it because that wasn't what I was doing, if that makes any sense whatsoever. So, since I made this switch, I feel much more confident as a trader, and it really just suits my personality. And it's not going to suit everybody's personality. Some people love day trading. Some people are position traders. It really all depends. But I think, I feel like I felt like this huge relief over me when I found, kind of the style that suited my personality better, if that makes any kind of sense.
It absolutely does to me, because I think that too many traders get their minds set on finding a strategy, a technical strategy or fundamental strategy that they're going to use, and they're going to use it forever. And then the markets change the story on them, and then they have to adapt and change to the changing markets. We've all been through this. Right. If you've been trading for a while, you've been through this. If you haven't been through it yet, believe me, you're going to be tweaking your strategy forever. Our job never ends.
Right.
But not only will you have to adjust your strategy or adapt your style and strategy to changing markets, but you will have to adapt it to your changing personality, if it changes. For me, it changed. Shai, for you, it changed.
Right.
We both, for me, it was a combo of the two. Obviously, scalping for size like I did for as many years as I did. Eventually, the machines got the better of me, gave a nice chunk back. And then physically, I had a heart attack, which also caused me to not want to be intraday trading as much. So I had a lot of reasons why I had to change. Markets forced me to, and physically, I felt like I had to. So But in that change, it was really, for me, going back to what you had just said, going a little bit longer term, and I'm still intraday trading, but just not scalping, it better suited my personality.
Absolutely. And I think everybody kind of does that. Or, you just kind of evolve.
How did you end up finding your strategy, finding your edge?
Well, two things that would really resonate with people is it's the same two things that you do to buy a car or a house. It's number one, know what other markets influence the market you're trading. So correlations, all right? Not that there's always a leader and a lagger. Oh, this market goes up, I could buy, life is good. It's not that easy. But it's important to correlate markets that influence your price, and I'll get into that in a second. And the other one is order flow, but not in a super general sense, because order flow has become a buzz phrase. People do a search and they try to learn, everybody and their cousin is teaching order flow, and there's nothing wrong with that. But when I learned it, I learned to ask the right questions. And what I try to tell people now is forget about the right answer. Look for the right questions. And you're almost forced to ask those in a prop environment because you're around guys that are doing what you're trying to learn. But it always came back to those two concepts. Even when I was a clerk, it was I'm clerking the Eurodollars, which is an interest rate market. I'm looking, and I got to be on top of where price is and be pretty accurate, right? Because you get a customer tear your head off if you give them a bad quote. Well, I was told, look at the bonds, and if they rally 6 or 7 ticks, watch your offers. Well, what does that mean? Well, offers in the Eurodollars might turn to bid because the bonds are rallying. Now, it wasn't perfect science, but it was an extraordinary helper to understand how to do your job better. So any strategy that people have that I have to include those two concepts, right? You could bring in other things, and that's great, but they have to include those two. So when I was in the pit, okay, I understood order flow. I took some great classes about pit trading and understanding where your leans are, understanding where big orders are coming in and what price and what that meant. But I was weak on correlations, and I shouldn't have been because that's what I used as a clerk. But it didn't dawn on me, and this is what's so important for other people listening, that the obvious sometimes runs right by you. I'm standing in the pit, the whole other side of the pit, and you'd appreciate this. They're looking at the board. All their heads are turned looking at the board. And it didn't dawn on me that they were looking at the S&P price at the other exchange because it was going to lead the Dow futures. So the S&Ps went up. They could buy offers and get long the Dow. Maybe it would follow it. Maybe it wouldn't. Well, what that did for them and allowed them to trade was it stripped out randomness. And randomness was really difficult for me to trade because, and it would be electronically as well. If you have no idea that price could go up, then you're going to have a lot of fear. And a lot of fear is just going to make you miss a lot of good stuff. And it's because when you are right, you feel like you got lucky or you feel like it was a good guess. That's not going to last. You're going to be lucky for a long time. And so my strategy always came down to, why am I bullish? Let's just play from that side. Why am I bullish? All right. Is it fundamentals? Is it direction? Is it some pattern? And then where is a good location to execute that opinion? Because people think that if I could find a great way to create an opinion, I'm there. You're not there. That's not even half of it. You need a good location to execute that opinion. So your strategy and your setup then has to quickly morph into, all right, I'm bullish for good reasons. Where do I get long? And where the hell am I wrong? And you have to notice when you talk to people, when you learn from people, when you are even trading, implementing your own strategy, is always know where you're wrong first. And you know this from taking the same education on the floor back in the 90s, the whole know where you're getting out before you get in. And so that's where your risk is. So people want to learn how to manage your risk. Well, start by knowing what it is before you take it. I always try to end when I talk to big groups, manage your risk before you take it, which means know where you're getting out for losers before you get in. So that's a part of finding a location. But I'm looking for locations, just not on pullbacks, but I'm looking for locations where in a chart and reading flow, not every uptick and downtick because you go crazy, but reading flow where I'm bullish and I'm waiting for selling to come into the market at a price that I think could be support, but the qualifier is selling comes in and the damn thing can't go down. And you know as well as I do, as well as anybody who's traded for 5 days or 5 years or 50 years, that when something is supposed to happen and doesn't, has to be where your clue is. So when there's selling that comes in, a lot of people will say, well, then be short. Well, if selling comes in and that's the right side, it probably already ran down and the premium is out, because selling should push price down. And when it does, there's no clue there. But when selling comes in a moment that you think there could be a bounce and it doesn't move price, like a big push of selling come in aggressively, price couldn't react lower. That's your when moment. And then you adjust to where am I wrong in this instance and what should happen. Now it's not random, right? The probabilities of you got support, you're bullish for the right reasons, now you got selling coming in and it can't go down. Now you've got probabilities, so it doesn't feel like a good guess when you're right. And a lot of people that want a green light, red light would rather just say, all right, I'm bullish, just buy 46s. You know as well as I do, you're not bidding 46s. It's going to fill you, maybe go down to 45 half in the S&Ps and then rally to your target of 50 or 60. It's not going to work. You're going to miss a lot of winners because it's not going to fill you and then rally, and you're going to catch every loser. So it could never be that easy. You're going to have some skill in finding that when moment of other people trapped or stuck. And it goes back to what I said earlier. You have to listen in a way and watch what other people are doing, because price isn't going to go up unless it's cheap. It's not going to be cheap unless you find buyers, and you're not going to find buyers until you get people stuck short. So one of the things I've said to people that has resonated, like when Mickey had told us back in the 90s, second trade first or know where you're getting out before you get in, it's always stuck with us. One thing that I think sticks with people that hear it is after you buy it, you're a seller. And after you sell it, you're a buyer. Meaning after you buy it to get long, you now have to sell it at some point, right? 5 seconds, 5 minutes, 5 days. You have to sell it. Well, in the case that I'm trying to walk you through a strategy is at a moment you think the market could bounce. If you can get people who sell it because to get short, now they have to buy it. And if you could tie in, if you think of circles of skill, and you could overlap the circles where you got good support because people were trapped short there moments ago or a day ago, that's why it's support. You're bullish for some good fundamental reasons. And at that moment, you're thinking of getting long. You qualify in that area where a new group of sellers who now turn to buyers sell it, and now they got the big grapefruit eyes because they have to buy it. And that's what and where and how the whole dynamic of a price that rallies, where it comes from. That's what makes good support good. Trap shorts that have to buy it and they're begging. And then, price rolls down there and you get a new batch of aggressive selling, and it doesn't go down at that particular moment. And that again becomes your win moment. And the metaphor I use, Ant, is punch a guy in the face. If you punch a guy in the face and he doesn't flinch, I don't know about you, but I'm running the other way. I'm too old. Back when we were young, we'd stay there and get our butts kicked. Now I'm running. Where are those moments in the market? And that has to be a part of anyone's strategy. Even if you're a longer time frame trader, you still have to trade real time. You have to read real time. You have to find good location. So one of the things about strategies are you correlating with other markets? Do you understand what's driving the market? Like this whole thing, people are going to watch this or listen to this in months or in years. But right now we came out of Sunday because of new information that, politically, where Bolton might elongate this impeachment. Markets don't like that. The coronavirus is still a problem. Markets don't like that. You have to know unequivocally that's driving the market. You have to anticipate, not that you're going to trade news, but you understand that, hey, this comment or that comment could make us bullish or bearish immediately, and now diligently react to it. That's about being a trader, knowing what's driving. That's about being properly prepared before the week, before the day, and everything else. Every guy who's traded successfully, that trades successfully, profitably, knows exactly what's driving the market. We anticipate what could come out next, helps us frame our opinion. And if nothing's driving the market, then it becomes more a pattern in a chart, trying to buy a good pullback off a healthy rally, but in support where people missed it, stuck short, and sellers come in and it can't go lower. So, in a nutshell, that is where I'm looking to execute. It's all about location for me.
So you and I are also similar in that we look at macro themes, but we make our decisions, how we manage our risk is through technicals. And we're aware of the macro, but we go to the charts for the information to be able to execute. So I would like for you just to explain to everybody, because you did just mention some macro themes that you're looking at, how do you approach using macro alongside with your technical, even though, like you said, you're shorting your time frame? Because I think a lot of people are like, well, if you're trading a shorter time frame, what do you need to know macro for?
Oh, terrific question. I think that if we're day trading, is macro going to make its way into my analysis if I'm looking for a clearing range breakout or some sort of, hourly price movement range exhaustion? Probably not. I'm going to recognize that the economic events that on a rate of change basis shape macro. Those events are going to be released, our 8:30 or 9 or 10 o'clock economic releases, and that's going to create volatility that I'm going to have to trade through or choose not to trade through. So day trading wise, it will probably give me a directional bias. Like right now, I don't want to day trade to the short side. I'd rather pass on those days where my day trades trigger short and just wait for pretty much long day trades, because that just from a probability standpoint since October for me has been working better. On the longer term time frames, we get out to dailies. It's so right what you say when we go take a macro theme or even a news theme or even a psychological theme and we go back to the charts. I think you and I go back to the charts for the same reason, which is the market can absolutely choose to ignore a macro theme. We've been ignoring a slowdown in the ISM below 50 for months now. We've been ignoring earnings on a rate of change basis, slowing down now for probably at least 3 quarters. We've been ignoring the GDP getting down to the single digit, number one or 1% or less. So number one, we're ignoring macro. I think the overall psychology of the market is, everything's awful, but the Fed's going to save us. And we kind of can point our finger back to it with the expansion of the balance sheet in July and August. So that's not a buy trigger for me, but it definitely gives me a buy environment.
So a few things I want to talk about here is, for me, the macro on the shorter term, why I like it is because why I follow it and read a lot about it is because my worst days are trend days, right? A day where the market just keeps going up and it goes through every resistance level, or a day where it keeps going down and it goes through every support level. I trade both sides of the market a lot. Not as much anymore, but my reasoning why I started reading macro and learning more about it was because I noticed that those trend days were the days where the macro themes coincided with the technicals. And I wasn't aware, not that I really wasn't aware of the macro theme happening that day. Obviously there was a headline or a data point or something, but I would be stepping in front of that at my support or my resistance just because there was something on the chart telling me that. And going back to what you said is exactly the way I approach it now, because I started getting more involved with the macro, is really just determining a side that I'll either trade more aggressive on or a side of the market that I may not trade on at all. And really that's prior to this call, you and I were talking about, just things in general, just chatting. And I said, really my best trades this year are the ones that I've stayed away from because I know better, right? I see what's going on and I'm going, you know what? I have these macro themes that are going on. I'm looking at the technicals going, you know what? I'm just going to stay away from this.
Mm-hmm. I think you bring up a great point, which is when I look back at all the years of my trading, the trades that I'm most grateful for were the ones that I didn't take, or, the ones that I was able to cut the drawdown on the quickest. I don't ever begrudge missing a big move. That whole idea of missing a big move, that's not been something that's hurt my career. It's what's probably made my career is being out of those moves that I had no business being in. So that selection, that sort of directional bias, as I like to call it, is for me huge. I mean, I think that having that bias every morning makes my life a whole lot simpler. I'm not looking for trades in either direction to trade equally. I might be, like you said, short, long, but I'm going to like one side of the market a whole lot better. And my sizing is going to reflect that for sure.
A question I constantly get is, what platform do I use to trade futures? Well, I use TT. They are the world's fastest commercially available futures trading platform. Now they have integrated tools for advanced options trading, cryptocurrencies, and trade surveillance. You could try it now for free at tryttnow.com. Well, let's pick one of your systems and take us through the entire process of you developing one of your systems.
Okay. I'll use as an example one I just created recently, and it's actually one that I give away for people who sign up on my website. So it's for the Mini S&P, and it's actually based on a webinar that I watched with Art Collins, who I'm not sure if he's been on your show or not, but he is a pretty well-known trader in Chicago. He's written 4 or 5 books. I think he's a commodity trading advisor. Anyways, I've long admired his work. And so he had a webinar that he did where he had a signal on the 5-minute ES chart, the Mini S&P. So that's the idea that I took. And that's pretty typical of how I do things. I'll usually find an idea somewhere, whether it's in a book or out on the internet or something. I just find an idea, but then what I'll do is I'll take it and I'll go and modify it and make changes to it and try to change things around. So the tricky part about that is what you don't want to do when you're doing that sort of thing is to, look at your whole historical database of data and test all your little variations of an idea on that, because what you're doing then is you're in effect just kind of curve fitting. You keep trying stuff until something works on all the data. So what I do, and this is kind of the next step in the process, is I do a test on a small chunk of data. So I'll just take 1 to 2 years of market data at random, and I will play around with the strategy. And by play around, I mean try some different things. Maybe try it with a stop loss, or maybe a profit target, maybe both, maybe neither, maybe a break-even stop, maybe a trailing stop, maybe add on to the entry and put some filters on it. So you can do that on a limited piece of data without really worrying too much about overfitting, because you're only dealing with part of your history. So during that phase, I kind of modified my strategy until I find something that meets some criteria I have that says, hey, this looks like it could be a good strategy. It doesn't say it is, because I haven't tested it over all the data. It just says, hey, maybe it's okay. Maybe it's worth testing further. And then I kind of lock the strategy down. So I know the rules. I know anything I'm going to optimize as far as variables. I try to keep that to a minimum. And then I tell myself I'm not going to make any changes. Now I'm going to do an advanced test over all the data, which is I use walk forward testing, which is something that was popularized a while back by Bob Pardo. And it's a neat way to get a lot of out of sample results for a strategy. Because, for example, if I took my strategy and just optimized it over all my data, it would be what's called in sample. And in sample is always too optimistic. It's almost never achievable in the real world, because as soon as you get some new data, what the system was optimized for won't necessarily work anymore. But with walk forward testing, it's a way to get what's called out of sample data and out of sample results. So I run this test with walk forward testing, and then I get what's what is an out of sample equity curve. And as long as that looks good, and again, I have some criteria for that, then I move on and I do some what's called Monte Carlo simulation. It's basically a random number type generator that will mix up all the trades that you had in your back test, and it will give you some statistics of, hey, what's your chance of getting wiped out if you trade this system, or what's your chance of a certain drawdown or a certain return. And I use those results to look at basically a risk-adjusted return. And because I want to make sure, obviously, that the return I'm getting is appropriate for the risk or the drawdown that I could potentially take. So that's the next step. And again, there's criteria at each of these steps. And if something fails, you just throw it away and move on to the next idea. And then the final one before you actually go live is to actually watch the strategy for a period of time in real time. So I'll create a strategy today, for example, and I'll document it and be done with it, and then put it away for 6 months, let's say. And then 6 months from now, I'll come back to it and see, how did it do these last 6 months? Did it continue its performance that it had during all my testing, or did it fall apart? And that will help me decide if I really want to trade it. Because no matter what you do, as far as trying to be careful with optimizing and not curve fitting, there's still a chance that's going to happen. And so doing this live test really helps eliminate some of those, duds, I guess is a good word for it. Those strategies that just fall apart as soon as you go live. Unfortunately, that's also the hardest thing in the world to do, is to spend a couple weeks developing a system and then put it aside instead of trading it. Everybody wants to trade it right away, so that's kind of a tough part of the process. But once you get through that, then the final thing is, okay, I've got a strategy. It looks good in my out of sample back test. It looks good in real time. Now I got to look, how does it fit in with my other strategies I'm trading? Is it correlated? So, for example, going back to that ES strategy, so I'd take it and look at it relative to any other stock indices strategies I'm trading, and what's the correlation of those like? There's no point in trading two strategies that are nearly identical. You probably just want to trade one of them, because your risk is basically going up if they're very highly correlated as far as results. But assuming it fits in, then I look at, okay, well, position sizing, and you start looking at that kind of thing and how to put it in a portfolio. And usually when I start out trading a new strategy, no matter what it is, I'll always start out with only one contract. So I start out really small and let it prove itself with real money before I even think of, allocating more capital to it. And that's kind of like a downside protection, because even though I think I've taken steps to do things correctly, there's always a chance that a strategy will fall apart. I mean, that happens no matter what you do, and it happens to everybody, that strategies eventually, will stop working. I always plan on every strategy I have stopping its good performance at some point in time. I just don't know when. But that kind of gives you a flavor. So I, just to summarize it real quick, I took this idea that I found from someone else, I modified it, I tested it on a little bit of data, said, yeah, maybe there's something. Then I did a more in-depth optimization walk forward test. Then I did some random number simulation with it. And finally, I did some real-time performance watching, and then it was ready to possibly go in a portfolio.
Hey everybody, I want to take a quick pause and talk about RJO Futures. They are a long-standing brokerage firm with personal broker relationships to learn, discuss, and trade the futures markets. To learn more about RJO Futures, please visit rjofutures.com. Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a review on iTunes. You can listen to all of our episodes on futuresradioshow.com, iTunes, YouTube, Google Podcasts, Spotify, and Stitcher.